Earnings season is important because it gives us an update on where the economic cycle is at and how things are progressing. We think about the economic cycle in terms of economic growth, the level of inflation, and where interest rates are set at. Are they restrictive? Are they neutral or accommodative? And a huge part of the global economy is on public markets, listed companies listed on stock exchanges, and they've got an obligation to shareholders to update those shareholders on how their business is progressing. So at the micro level, it's important to see how individual companies are doing versus their strategy, regardless of what the global macro is throwing at them. And then at a sort of macro top-down level, we can also, in aggregate, we can get a feeling for how different parts of the world, different sectors are progressing in this economic cycle. And the economic cycle, of course, is a big driver of the market cycle, how share markets do, how the returns from bonds, and where our cash rates are set at. The earnings season so far has been a pretty good one. If it was a report card, we'd be thinking about giving it a B+, maybe even an A-. We've seen good earnings reports in aggregate in both the US and Europe, and companies so far seem to have done a pretty good job handling that uncertainty that's been in place since the sort of tariff changes were talked about, were mooted. We still don't have exact visibility on what the new global trade picture is going to look like, so we're still in these uncertain times. But at least for the second quarter of 2025, companies have done a pretty good job managing those changes and those uncertainties. And so looking backwards on the second quarter earnings, outperformed expectations, up sort of 19% from a year ago. So those are big ticks. And then as importantly, when companies report their past earnings, they're also expected to give some guidance on their expectations for the next few quarters. And that has also been, again, if we think about the next 2 quarters of this year, that has also been pretty well received, pretty positive, that companies are confident enough in their business and their industry to keep that guidance sort of around where it was. Oftentimes during earnings season, there will be a bit of a sort of downgrade. People are lowering expectations, and we haven't seen that as much as we have in the past, which is a positive. One of the key macro takeaways from the earnings season was a broader announcement of CapEx intentions across a number of different sectors. Some of the past few earnings seasons have been dominated by the Magnificent Seven, those large mega cap US headquartered technology and advertising and platform companies that have been doing a lot of the spending on AI. Would be the most prominent example. Of course, that's very good for the likes of NVIDIA. Interestingly, this earnings season, we've seen a lot more much smaller companies across other industries, other sectors, also announcing intentions for more CapEx. Some of that CapEx is still AI related, but we're talking about companies in the industrials, defense, engineering, the utilities sector, so power generators, whether it's nuclear energy or electric energy. They're also rolling out some CapEx plans. Not necessarily the same as the CapEx we would have seen 10, 20 years ago, where it might have been building new plants, new factories, putting in a new IT system. This is more of your sort of modern CapEx, investing in can we use AI to make our business more profitable, more efficient, and that is still an aggregate positive for the economy, because one company's capital expenditure is another company's revenue line. So that broad-based CapEx intentions and confidence to commit to those programs is a positive for the overall economy. Another takeaway when we think about the earnings season in aggregate is the way companies have managed to handle this uncertainty, and yes, some price increases in some parts of their supply chain or business models. They've had to take slightly lower profit margins in some cases to deal with higher prices, but they've also been able to pass some of those higher prices on to the end customer, the end consumer, the end client. And there's often a sort of middle businesses, middle people in a sort of specific ecosystem or industry, and they're also having to take slightly lower profits than they would have otherwise. So the fact that the increase in prices from the tariffs has been shared around that sort of economic ecosystem in many industries, that is also a sort of positive in terms of the economy being able to absorb those higher prices. It could still eventually flow through to higher inflation prints, which would be a negative. It's one thing the likes of the Federal Reserve in the US are very focused on, but if it's sort of evenly shared, it makes it a little bit more palatable for the economy overall.